Hello and welcome. This is the Insurance Pro Blog Podcast. I am Brandon Roberts.
And I am Brantley Whitley.
And you are listening to the internet's favorite podcast about life insurance.
That's
and bonds.
right.
And stocks. And lots of other things.
Oh, yeah.
Or maybe we should just stay in our lane and say life insurance. Favorite life insurance. Let's stick with that.
Yeah. Yeah, let's stay there. That's
Okay.
good enough.
So what did we come to talk about today?
Well, we're going to talk about life insurance and stocks and bonds today.
Oh,
it turns
look at that.
out. So
So we're not going to stay in our lane. Well,
and we're going to talk about we are in the business of slaughtering sacred cows here. That's our new motto.
mm-hmm.
And today we're going to take on one of the sacredest of sacred cows, the 60-40, the 60-40 stocks to bond sort of forever portfolio. I don't even know what to call it.
So are we killing 60% of the cow or 40%? I'm confused.
And we're going all in. We're going all in. No, this is just a. Sometimes we just do things that are just purely academic.
We do.
And this is one of those times.
We do.
And
I can tell you there is no...
The 60-40 portfolio has been the sort of recommendation that I called it the forever portfolio, but what's the right term? I can't think of. It's just sort of been the widely accepted like
Default
if you want to take like a 4% withdrawal in retirement, the 60-40 will work in most or all market periods, I guess is the but there has been in recent years some revisionists going back and saying, well, maybe it doesn't work as well as we thought it did.
Well, there's a little bit of a problem.
Yeah. Well, that's what we're going to talk about.
And that problem mostly sits on the 40 side.
On the bond side?
Yeah. So,
not to say there's something wrong with bonds, by the way. And
No.
we should do our disclosure here.
Yeah.
We don't sell stocks and bonds. So the Insurance Pro Blog podcast is life insurance. We sell life insurance.
Here for informational purposes. And you can buy life insurance if you want.
Yep.
Or annuities. What else we got? Prepaid legal? No, just kidding.
No.
Just kidding. So the 60-40 portfolio has long been justified, promoted, talked about in the context of back-tested results that span several decades, but those decades were commonly something like the 70s, the 80s, and the 90s, maybe the 80s, the 90s, and the 2000s timeframe. And this we commonly saw as a justification for the style portfolio because it had a certain expected rate of return that looked pretty solid.
Mm-hmm.
And more recently, we still talk about the 60-40, but the one thing that we're not discussing nearly enough is the fact that the bond market went through a magnificent bull market starting in the late 80s and persisting through basically the end of the 2010s.
Right.
There were two things driving the whole ship. We had super, like once in a lifetime high yields.
Yep. Mm-hmm.
Where people were able to buy in. I mean, 10-year treasuries peaked at like 15.84%.
It's crazy.
10-year treasuries, 15.84%. Like that's
And
pretty
that
good.
was a result. That was a result of the sort of hyperinflationary environment of the late 70s, right?
Mm-hmm.
That interest rates rose to try to control things.
Yes.
To get things normalized.
And if 10-year treasuries are at almost 16%, you can bet other things were similar and higher.
Yeah. I mean, this is back when 30-year mortgages was common for 30-year mortgages to be north of 10%.
Yep. So you buy one of these bonds, whatever one it is, you collect some pretty killer income for a while,
mm-hmm.
and then interest rates come down.
Yep.
Which means the value of that bond that you own rises significantly. Because if somebody were to go buy a new issue bond, they don't get what you get.
Right.
So if you want to sell your bond, you get a premium for it.
Mm-hmm.
And this benefited immensely a number of bond investment companies. So the mutual funds that primarily used bonds as their investment strategy. And it made a number of bond-focused funds look fantastic. I would argue that this is the thing that made Bill Gross, the household is going to be the word that came to mind, name that he kind of is if you're really into the investment world.
Or if you were like 25 years
well, yeah, if you were several years ago. For the new people around here, there was this guy, he was known as the Bond King. So
he managed a very famous fund called the PIMCO Total Return Fund.
Yep. And I mean, kind of right place, right time.
Yeah. I mean, I will say we didn't know that. We didn't know it at the time.
Nope. So,
of course, we have the luxury of hindsight now, right?
We do. And the issue moving forward is we're not going to see the same bull market in bonds unfold for the next 10 or 20 years.
Right.
Not without some gigantically big change in what's going on macroeconomically right now.
Right.
Because here's the fundamental problem. Here's why I can make that statement with all of the certainty in the world. We don't have enough rate to drop right now to create that sort of bull market.
Right.
Interest rates are not at a place where we can reduce them over the course of the next 5, 10, 15, doesn't matter years to create that sort of appreciation in bond values.
Right.
And you're certainly not collecting the income that would have existed back then.
Right. Yeah.
So because of that, the 40 leg of the 60-40 portfolio will not perform like it did in those back-tested examples that have the 90s and the 2000s in their sample years.
Mm-hmm. Yeah.
It won't work. And that means we have
You got to start saying something I disagree with so I can have some commentary to add here. Like, yep, you're right.
And this is not just our conjecture. Like there are very serious investment analytic style companies out there conferring with all of this.
Right.
In fact, as recently as last year, both JP Morgan and GMO both put out reports that told us we don't have super lofty expectations for bonds. We don't have super lofty expectations for something in the neighborhood of a 60-40 bond portfolio.
Right. Can we talk about something real quick? Because I know I don't want people to hear something we're not saying. Right.
Mm-hmm. Sure.
Because what people are hearing is but you guys think bonds are stupid. It's like, nope. That's not what we're saying at all.
Nope.
We don't think fixed income is dumb. We don't think bonds are stupid. And you correct me if maybe I'm not characterizing you correctly, and I don't want to mischaracterize it. But from my perspective, what we're trying to point out is the flaw in total return thinking.
Yes.
As it relates to the 40% being in passive bond funds or ETFs or whatever. Right? Is that?
Yeah, exactly.
That's a fair.
Yep. So when we talk about bonds, we're not telling people not to buy bonds.
Right.
We're telling
not
people
telling
not
you to buy bonds because we don't.
No.
We're not giving you advice one way or the other.
But what we're really trying to get people to do is think about using bonds for the sake they exist.
Which is
income.
Right.
We, I believe, I can say this, are both very much income favored, income looking for, income seeking.
Yeah. Well, how else am I going to have to be able to stop working for money?
Yeah, exactly. I mean,
that's the way I see it. Maybe that's oversimplified for a lot of people, but I go, if I want to stop selling insurance policies one day, I'm going to have something to replace that income.
No, insurance is fun. You never want to stop, right? I mean, look, I spent several hours a week last year and some even this year working on a solo project that tried to get people to focus exclusively on investment income style portfolio building. Believe very strongly in the value of what bonds can do from an income perspective.
Right.
Don't care at all. Well, don't care much about trying to look at bonds for total return.
Right. Total in the context of total return, at least the way I think of it is, and this is where this time frame, which is, remind me again what time frame we're looking at, 81 to 2022 through 2022. Is that the period we're looking at? 2020.
2020 through 20.
Okay. So that time frame is what built this whole intellectual framework around bonds being less volatile than stocks.
Mm-hmm.
You think I'm right about in saying that?
I do.
And that they were inversely correlated.
Mm-hmm. I would tell you that bonds are not the asset of low volatility that they've been made out to be.
Right.
From a total return perspective.
Right.
And they are not inversely related to stocks.
Right.
They simply don't move with what the movement necessarily of stocks.
But they're not inversely correlated, though.
Part of the academic thought behind inversely correlated is that they were a substitute for stocks.
Right.
So if people left stocks, they'd go to
bonds. Yeah.
And look, I'm not arguing that
the flight to safety. That's what people always talk about.
I'm not arguing that we can't find periods where that exists.
Of
but
course.
In recent history, so like 2020 to now, when people leave stocks, they've been much more apt to jump to cash.
Mm-hmm. Yeah. Can't say I blame them.
So,
I mean, if you've already lost money, it's like, where do I go to not lose more money?
Mm-hmm. And
under my mattress. I mean,
yeah.
I'm being tongue in cheek, but you get my point. I mean,
I do. And the big message here is the way that we're looking at this is think of the time frame as like 1980 through current-ish day, and then current-ish day out another 40-ish years.
Right.
What we think and what the setup strongly supports is the idea that the first 40-year period is going to be the one with a much higher expected rate of return, total return-wise, on bonds
mm-hmm.
than the second leg.
Right.
And obviously, if you have two legs, there's an average between them. And when we revert to the average here over this second leg, it's potentially going to be really painful for the people who are expecting what happened in the first leg.
Right. Right. Well, to your point, it's mathematically impossible.
Yep.
It can't match.
Nope, it cannot. And thinking it will is like trying to drive forward while looking in the rearview mirror. It doesn't work well.
Right.
And it's setting people up for a seriously false expectation. And I can't understand for the life of me why everybody who is in the business of dispensing anything associated with financial advice, investment advice, financial ideas can't look at these numbers and go, oh yeah, you know what? The 40 part of the 60-40 portfolio, those return expectations are not going to look as good as they did for the past 40 years.
Right.
Because we don't have enough interest rate going on to support that right now.
Yep. Exactly. Mm-hmm.
So that brings us to an academic,
what's that got to do with life insurance, Brandon?
Exercise here.
Okay.
Which really looks at, well, all right, like, how do we think whole life insurance compares? Because the interesting thing about whole life insurance is it's it has some of those things that we wish bonds had, like true decoupling from the stock market.
Yep.
Not saying it's inversely related, it's not, but it just doesn't care. It is non-correlated.
Yep.
And unlike bonds, where changes in interest rates, increases in interest rates can be kind of painful, whole life insurance instead just kind of increases return in most cases, because those rising yields create higher dividends. Not immediately, but for the most part, that's how the momentum works there.
Mm-hmm.
So no surprise if we take like a back-tested 40-year 60-40 portfolio and compare it to what whole life insurance would produce, the 60-40 portfolio comes out ahead.
Right.
But if we isolate the bond component and start to question, well, all right, how did just the bonds compare to just the whole life insurance, which is what we've been advocating for since basically the beginning of the Insurance Pro blog, what we see is kind of alarming when it comes to the default adoption of bonds as the option.
Okay.
So the setup started with $1 million and a 4% withdrawal rate. And I kind of figured that
so we're assuming someone is at retirement at this point.
Yeah, at retirement, they got $1 million and we're going to use the 4% withdrawal rate, which, okay, I'll admit I kind of got over my skis a little bit in terms of how I rushed into this math, but it had worked out just fine as far as the kind of risk on side of it, if you can think of bonds that way. Because we got to net out for taxes.
Right.
So we got $1 million in bonds. $40,000 would be the income number that we want to net. So we're going to need something like a 51,000 and change distribution, assuming 22-ish% effective tax rate. So if we do that, our bonds will survive. Our bond portfolio will survive. Mm-hmm. And again, I'm using this bull market as my back test. So that income of $51,000 and change nets $40,000 of actual income, and again, 20-ish% effective tax rate. We end up with $800,000 of cash left.
Mm-hmm. And that was between 1996 and 2025. Is that right? Yeah.
Yes. I was trying to do the math real quick in my head. Yes. That time frame. If we do that same scenario with whole life insurance, we don't have to take the $51,000 withdrawal because whole life insurance doesn't have the tax issue. So the net is 40. We can take 40 from the beginning.
Right.
We have more than double the cash at the end of that same 30-year period. It's a little over $1.7 million.
So we took the same amount of money out.
Mm-hmm.
Well, actually,
but we've netted out the same amount of money.
Yeah, but you've netted the same amount of money.
Yeah. And we end up with
twice as much
money left over. Mm-hmm. And then we can talk about legacy value, death benefits even higher. Hurrah, hurrah.
Sure.
But okay, that's one observation. Cool. It starts to tell us that, hey, maybe we should do 60% stocks, 40% whole life insurance. Or something of that nature. But let's back up and stress test this just a little bit further, because not everybody's just sitting on $1 million. What does this look like if we try to accumulate that much and then distribute it from both asset classes, bonds and whole life insurance?
Right.
So, when I set this up to get the real numbers for the whole life policy, I needed to figure out what we needed to do setup wise to get to that $1 million balance to do the income thing for that first comparison.
Yeah. Right.
So it's easy to do. We just figure out the IRR and then we calculate what the payment is and a time value of money calculator to arrive at the actual premium, which comes out to like $21,000 and something. $21,389.
Yep.
Is what we needed. So $21,389 goes into bonds, and we're using the VBMFX. I said that right. I always like to mash these letters on the tickers. Yeah, VBMFX. That's the Vanguard fund.
Because it's been around for a long time.
Been around for a long time. It encompasses a big component of the bond market. So using that one and assuming a systematic investment of the $21,389 for 25 years, and then the same 51,000 and change distribution. First, we don't get to $1 million in the bond investment after that 25-year period. So the rate of return of bonds, even over that great bull market period, isn't as good as the anticipated rate of return of whole life insurance.
Right.
The bonds, they actually start out at like just under $800,000. Now, the good news is 30 years of that $51,000 income works. Like, we don't have a lot of money left over, but we still have money. We got like $78,000 left over. The whole life, that's not different. We're starting exactly where we were in that previous example. We still have the $1.7 million of cash.
Right.
So this starts to even further cast doubt on the superiority of bonds as the default option when it comes to focusing on total return of bonds.
Mm-hmm.
So to your point earlier, this is the critical step here. If we are saving money for the sake of accumulation, driving into eventually the creation of income, we are coming to you today to suggest that whole life insurance may very well be the better, safer side of the portfolio than bonds are.
Yep.
Based on this style of analysis. That doesn't mean if somebody's sitting on money and wants to just buy income for the sake of buying income, they should absolutely ignore bonds. That's not what we're saying. And I don't want people to make that assumption.
Yeah, for sure.
And we truly, truly, truly believe that from a total rate of return perspective, moving forward, bonds are going to be quite underwhelming.
Yeah. Well, we're not the only ones that think that. People a lot smarter than us think that.
Mm-hmm.
Well, again, I don't think you just have to understand a little bit of math.
Right.
Like it's not some deep prognostication. You just look at math, you go, well, I mean, I don't know how that could be. Like, even if interest rates went to zero.
If interest rates go to zero, we're not going to see appreciation in bond value. That's even half of what we saw taking place over the bond bull market from like the 90s.
So to me, that the more fascinating point behind all of these numbers and all these details, and look, I hope everyone listening goes over to the Insurance Pro blog to read this post. I will try to remember to link this in the podcast description.
Mm-hmm.
The written post, because it's got a lot of numbers, so you're really going to want to look at this. It's just fascinating to me, and I think to you, that the investment industry, or I don't know that I should say the investment industry, just the investment culture of our country has accepted this hook, line, and sinker, and it's based on a very specific set of circumstances that occurred over a very limited and specific period of time.
Mm-hmm.
Despite the fact that every disclosure we have on every investment document says past performance is no indication of future results.
Mm-hmm.
And the reason that disclosure is there is because it's absolutely true.
Yeah.
We don't know that it's going to work out the same way in the future just because it happened a certain way in the past. So, but mathematically, bonds are not going to be able to return on a total return basis. People, if you don't know what that means, go look that up, okay? We're not saying bonds are bad. If you buy a bond and you collect the interest, the coupon, as they call it,
yep.
and that's what you like, then that's totally fine. We get that.
Yep.
But expecting the underlying value of bonds to protect you in some kind of way.
Yeah, there's two things I want to. First, was that all you wanted to say?
Yeah. That's just
okay. So two things. One, people primarily invest in bonds thinking about the account balance that it creates, and they think of bonds as being less subject to loss than stocks.
Yeah.
Because that's what they've been told.
Yes.
And what we're telling you is not going to work that well in the future.
Right.
And here's the bigger thing from a risk reward perspective in my eyes. Bonds, like high rated corporates, treasuries, 10-year treasuries, they're sitting somewhere in like the mid to high 4s to like the higher 5s right now.
Mm-hmm.
So as rates go higher, the likelihood that they will go even higher starts to decline. That's the case because the circumstances that necessitate them going higher become much more dramatic. So to get from 4% to 5%, there is something that has to happen to compel that. And the thing that has to happen to compel 6 to 7 is even more significant in terms of economic conditions. And that continues to happen. And that's why we don't see linear kind of shooting up of interest rates hardly ever.
Yep.
So the circumstances put a little bit of buffer on increases, but not like huge amounts of resistance. At least not at the levels that we're at right now. If we're at 15%, slightly different story.
Yep.
Now, the number of things that could happen over the next 5 years that would get us from where we are at right now to double are, I would argue, significantly larger in terms of possibilities than the things that would happen that get us to half. And if we go...
You mean an interest rate?
Yes, sorry, in interest rates.
Yeah.
So even if we were to not double, but just increase by 50%,
yep,
that's going to have a massively impactful effect on total return. And I would argue that it's I don't know that it's more likely than going in the reverse direction, but it's probably equally likely.
Mm-hmm.
And it is very impactful from a total rate of return perspective.
Mm-hmm. Mm-hmm.
And the problem that everybody who's trying to buy bonds for total return is going to run into is if that event takes place and bond values go down, bond values do not bounce back like stocks.
Right.
So if you take the loss, the odds that you're going to come back to even break even on the same time frame that you're used to seeing take place with stock investments, it's probably not going to happen. And I'll give you my recent history to support this. 2022, we all know, bad year for bonds. But this entire decade so far has been abysmal for bond investments, outside of those who have bought for income.
Yep.
Again, those people, they're fine. And they're collecting income, loving life. Mm-hmm. But if you look at major bond indices, VBMFX is in this boat, BND is in this boat.
I'm looking at I can't say it. It's too many letters. VBMFX.
Yep.
I want to abbreviate it to something else, but because it's got an MF in there. And I'm just looking at a 10-year chart.
Yeah. Yep.
It's not.
It's not great. And look at the 5-year chart. Look at the 2020 to now. They're flat or slightly negative. That's a long time of getting absolutely nothing.
That fund is down 16% in the last 5 years.
Mm-hmm.
14 over the last 10. 14 and a half, roughly, for the last 10.
Yeah.
So, I mean,
it's supposed to be a safe asset, and all it's done is...
peak value was in 2020 when interest rates were effectively the lowest they've ever been.
Mm-hmm. Now, there are some people who are going to push back on that past statement, at least in like the last 5-year statement, to be like, well, if you buy whole life insurance today, it's going to take you 5 to 6 years to even have a gain in the policy.
Yeah.
And that is a true statement. But you're also not going to have the loss over that 5-year period for a correctly implemented whole life policy that you have in VBMFX at this point.
Mm-hmm.
That is an incredibly important thing to understand when it comes to total return and how you strategically approach setting up your portfolio.
Yep.
That's what I wanted to say.
Okay.
So actually, the one last thing I'll note is that we're not alone in coming to these sorts of conclusions about how whole life could be the replacement to bonds when it comes to total return kind of buffering inside your portfolio. There are others. Yes, they're industry insiders for the most part that have come to the same conclusion, but we're not working together.
Not yet.
So we're looking at the data. We're drawing identical conclusions on our own, which suggests there might just be something to this.
Yep.
Okay, now that's really all I want to say.
And I mean, those people are not pro whole life insurance.
Nope.
I mean, they don't sell life insurance. Is my point.
Yep.
They're I mean, we could be accused of all sorts of things. We're a bias source. Okay. But these people are not.
Mm-hmm.
So.
Yep. So.
And there's been some studies that have gone back for years. Who was it? The big accounting firm that ran something several years back. Was it Ernst & Young?
PwC. No, you're right. Ernst & Young. Sorry.
Now they could have been commissioned by life insurance to run the study, but one would assume they have to, independently verify the numbers are not made up whole cloth. So.
Yeah, they're not going to massage the data.
Right.
That's not worth reputational harm.
Yep. Exactly.
So,
well, yeah.
If they crunch the numbers and say, hey, there's something here, there's a good chance there's something there.
Yep. Exactly. Well, I do have one more thing before we wrap.
Sure.
And I just wanted to say, if you're sitting on a life insurance illustration right now, and it's something that you're trying to decide on, or a policy that you already own, and you're not sure if it's actually doing what it's supposed to do, we want to ask you to do something. Don't let ChatGPT be the last word on it. Like, I know that's what everyone does now. It'll hand you a really confident opinion, and a lot of the time, it's just repeating "whole life is a ripoff" line that it scraped off the internet, and we know because we've tested it out. And it can't be, I guess the right way to say it can't be wrong out loud, and it can't be there when it actually matters. We can, and we will. Mm-hmm. So no pitch to you guys, and we don't do sales calls. I don't know if we've made that clear. We're not really good at the wholesaling thing, but if you'll send us, an illustration that you have, or just a bit about your situation, and tell us what AI told you or what your advisor already told you, we'll give you a straight read. We'll tell you what's right. We'll tell you what's wrong. And honestly, whether we think it's a good deal for you or not. So you can use the contact us link on our main website, theinsuranceproblog.com. We also have one in the podcast description. You can schedule a call if you want to go that route. Either way, but we would just encourage you to do that.
We have our fancy internal AI model called ChatBDW.
Exactly. We won't tell you what that means.
Gives way better answers.
It's proprietary.
Mm-hmm. Mm-hmm.
But if you got an illustration that you're weighing, or a policy you already own, you're just unsure about it, send it our way before you make a decision.
Sure.
AI always gives you super confident, sycophantic answers, and we'll just give you an honest one.
Mm-hmm. We can do that,
for better or worse.
Yeah.
All right.
I'm Brandon Roberts,
and I'm Brantley Whitley,
and we will see you next week.